With the market down over 18% from its January peak, it is a great time to consider a low-risk and income-generating investment strategy. There's a dividend theory known as bird in hand, which states that investors prefer stock dividends to potential capital gains due to the uncertainty of capital gains. Or in plain English, a bird in the hand is worth two in the bush. It has never been more true than during a volatile environment like we have today. Investors prefer stable and guaranteed payments over high-risk, high-reward strategy. However, managing and diversifying a dividend-oriented portfolio can be tough. Moreover, a typical stock in the S&P 500 only yields 1.5%, so it is not enough to create income to live off of in 2022. In addition, there are a lot of risks and uncertainties to consider that can be burdensome. ETFs could be a great solution for both. They take care of stock picking for you and create a basket of companies in the industry or theme they're focusing to lower risk and increase yield for investors. I have done the research among a broad selection of high dividend yield ETFs to pick the best ones, so you don't have to. In this video, I will show you 6 ETFs with dividend yield above the S&P 500 that everyone should consider adding to their portfolio. Watch the video till the end. Watch the video till the end to get the list of ETFs that you should consider adding to your portfolio today. As always, remember that this video is for education purposes only and does not contain financial advice. I am not your financial advisor, and whatever I mention on this channel is not taking into consideration your individual financial needs, risk tolerance, and time horizon. So do your own research before making any financial decisions. Now that we've got the legal part out of the way, let's dive in. For those of you who are new to the channel, welcome. My name is Neera and I'm a financial analyst. I talk about personal finance and investments and teach you how to make money and grow it exponentially. If you're interested in this topic, consider subscribing, as this will help the channel grow and impact more people. An exchange-traded fund is a basket of securities that is traded on a stock exchange. It has similar properties to stocks in terms of how it trades, but instead of investing in a single stock by buying one share of ETF, you're investing in several stocks that are part of the ETF. There are different types of ETFs to choose from depending on your financial goals. Today, we will be focusing on income-generating ETFs that provide high yields through various strategies. We will be looking for higher than average dividend yields, low expense ratios, and good track record of 5-year returns. Before moving to the list of high dividend yield ETFs, let's review the benefits and drawbacks of ETFs. Starting from the benefits, ETFs are of course a great way to lower your risk and diversify into several companies in one purchase, without doing the burdensome and at times complicated research of each individual company on your own. Number 2, ETFs are great for beginners. If you don't understand individual stocks yet but still want to put your money to work and start earning high dividend yield, ETFs are a great way to do it. With a little research into what types of companies the ETFs invest in, their expense ratio, track record, you could find an ETF that best suits your goals. Number 3, ETFs are easy to trade compared to other passive securities like mutual funds, for example. You can buy and sell anytime during the trading hours. Place market, limit, stop loss orders similar to trading a stock. Number 4, a specific benefit of high dividend yield ETFs is guaranteed paydays. Now that there is such thing as guarantee on Wall Street, the company can simply cut their dividends if the financial health of the company deteriorates or the management decides to go on a different path. Through ETFs, however, you will receive dividends from a diversified pool of companies under the ETF, which decreases the risk of being exposed to a single stock. However, as any other financial instruments, ETFs have some downside. First and most important of all, return is not guaranteed, as in any other financial instruments. Although ETFs diversify your portfolio, they do not eliminate risk. They are still at the mercy of the companies that makes up the basket. Number 2, actively managed ETFs have fees that could add up over time. While selecting an ETF, it is important to pay attention to the expense ratio. However, if you consider the time you spend on researching and trying to diversify yourself, the fee might be worth it. Number 3, ETFs that follow a specific sector might limit diversification. For For example, if you buy the BlackRock Future Tech ETF, ticker BTEK, your portfolio is only exposed to the technology sector. And when the market conditions are not favorable to that sector, you will lose more than if you diversified your portfolio to other industries like energy or financials. This means that you will need to diversify your ETF picks as well. Next, I wanted to clarify what dividend yield means, how it is calculated, and what factors to take into consideration. The formula is simple: annual dividend per share divided by current share price. The percentage reflects the dividends paid for the past 12-month period. For example, if a stock or ETF costs $50 per share and pays $5 in dividends, the dividend yield is 10%. There are two main things you'll need to pay attention to. Number one, growth of the dividends. If you have to choose between two ETFs with the same yield, you would want to go with the one that has demonstrated growth in its dividend payouts. Number two, stability of dividends. This applies to high-yield dividends particularly, with aggressive strategies that invest in low quality and lower credit ratings and hope for a higher payoff. However, there is more risk and high chance that you will not receive the desired income, especially during a volatile market that we're experiencing now. High-yield ETFs won't be able to maintain their promised dividends, so it's better to avoid them. You'll be better off investing in growth stocks instead if you want and are able to take high risks with your money. In that case, the reward will justify the risk better. I will now share with you 6 ETFs that are paying high dividends, mainly due to the industry that they invest in. Most of them, as you'll see, are invested in energy sector and utilities, which are known for paying high dividends. Add to that current good market conditions for these industries, and it's almost too good to be true. I will sort the funds by risk characteristics and start from lowest risk to highest risk. We will compare all these options to SPDR ETF, ticker symbol SPY, which is a passive ETF that exactly tracks the S&P 500 and serves as a good approximation to the overall market. The dividend yield is 1.41% and the expense ratio is 9 basis points. I will start with the ETF that is provided by the creators of the first index fund, Vanguard High Dividend Yield Index Fund ETF, ticker symbol VYM, one of the largest and cheapest ETFs. This is a passive fund, meaning it exactly tracks a particular index and invests in companies that pay dividends that are higher than average. It has above average historic return and below average historic risk, a perfect combination. Moreover, it has the lowest expense ratio from the list provided at 6 basis points. Notice that it is lower than our benchmark, which is 9 basis points. The yield is, however, double that of the benchmark at 2.79%. This scenario is great for a risk-averse investor who wants stable cash flow and low risk. Among the top industries that the fund invests in are financials, healthcare, consumer staples, and energy. You can see the share of each industry the fund has invested in this chart. Number two is Global X US Preferred ETF, ticker PFFD, which invests primarily in preferred securities. Somewhere between stocks and bonds, preferred stock could be a great asset in a risky environment. At the expense ratio of 23 basis points, Global X US Preferred ETF's dividend yield is 5.87%, which is a little over 4x that of the S&P 500. Top holdings include Wells Fargo, Bank of America, and NextEra Energy. The top 10 holdings make up 16.7% of the total fund, which means it is well diversified. Number 3 is iShares Mortgage Real Estate ETF, ticker REM. Did that remind you of the band too? Real estate has high barriers to entry, but not if you invest in the industry through real estate investment trusts, known as REITs. Or better yet, ETFs that invest in REITs. It is worth noting that REITs are required by law to pay out 90% of their income to shareholders and receive tax benefits, which makes them a good option for income-focused investors. However, not all of them pay high dividends, depending on the instruments they invest in and risk involved. REM focuses on mortgage-related ETFs and pays roughly 5 times the S&P 500 at 6.79%. The expense ratio is also higher at 48 basis points. You'll need to take into consideration that investing in this ETF considers higher risk, as almost 98% of its fund is invested in mortgage rates, leaving no room for diversification. As I mentioned earlier, the energy sector is one of the favorites among income-oriented investors, and especially this year, they have performed very well compared to general market. But given that energy prices are volatile, which affects their stock prices as well, investing in the industry can be tricky. Therefore, I would recommend investing in companies that are not prone to the price volatility of the oil and gas industry, yet still benefit from the high demand of the industry. ALERIAN AMLP ETF, ticker symbol AMLP, does just that. The fund invests in companies that engage in transportation, storage, and processing of energy commodities such as oil and gas. The dividend yield is 7.15%, 5 times the S&P 500 with 87 basis points expense ratio. One downside is that the fund is 100% concentrated in energy sector. So again, there is no room for diversification. Next, I wanted to include a global ETF in the list. It is important to diversify not just into industry, but into geographies as well. Global X Super Dividend ETF, ticker symbol SDIV, invests in global securities, including small to medium market cap stocks and currencies. Its top holdings include Chinese real estate companies, Brazilian utility company, and other emerging markets companies. Fun fact, it includes Halyk Savings Bank of Kazakhstan, where my alma mater is. The fund's dividend yield is 11%, which is almost 8 times that of the S&P 500 with 58 basis points expense ratio. Since the ETF invests in smaller stocks in emerging markets, it carries larger risk. Also, when investing in global securities, take into account tax implications. Consult with a tax professional if needed. High in the risk level is INVESCO Global listed private equity, ticker symbol PSP, which invests in global private equity and business development securities. The fund's dividend yield is 10 times that of the S&P 500 at a whopping 14%. However, the expense ratio is also high at 1.45%. Another risk to consider is the fund's high concentration in financial sector, which is at around 76%. In this chart, you can see the geographic allocation of the assets, majority of which are, of course, in the US, followed by UK and Sweden among the top 3. From the distributions and yields chart, you can see the volatility of the dollar value of the dividends, which reflects the instability of the industry. Investment in private equity involves high risk, but exposure to high yield and higher upside might be worth it. These were the 6 high dividend ETFs that I wanted to share with you today. Let me know in the comments down below your favorite ETF that pays above average dividends. Just another reminder that this is not financial advice, and the recommendation is subject to change due to different market conditions and other circumstances. Just because a financial instrument is a good buy today doesn't mean the same is true tomorrow. So bear in mind your individual risk tolerance and do a little research before making any investment decision. If you like this video, leave us a thumbs up, subscribe to the channel, and make sure you turn on notifications to never miss out. Check out my other videos on the channel for other money-making ideas you don't want to miss out on. As always, thanks for watching, and I'll see you next time. Oh my god, I don't know what to say here. Top holdings, 4x ratio. High dividend yield.